heading into our climate risk panel for today. I'm really quickly going to ask all my panelists here to introduce themselves. If you can give your name, your title, and the organization that you belong to.
Hello, everyone. My name is Derek Jun. I currently serve as head of climate risk for TIAA in Nuveen.
Morning, everyone. Thanks for having us. My name is Lauren Puffer. My pronouns are she, her, and hers. I am a director in sustainability banking at TD Cowen.
Hey, everyone. I'm Osho, for anyone who wasn't here this morning. I'm one of the co-founders of dClimate and CEO there.
Hi, everyone. I'm Sofia Alarcón. I am Associate Director for the Americas for the Sustainability Consultancy business.
Thank you. So we're going to get right into the conversation today. So as everyone knows, this panel is going to talk about different topics across climate risk, and climate risk is a huge topic. So I'm going to ask Derek here to kind of set the stage for everyone by just giving an overview quickly on what climate risk is, kind of giving an overview of physical and transition risk, and talk a little bit about the methodologies that go into measuring climate risk.
Sure. Hopefully I can just skip through the science and the basics that everyone
Absolutely.
here should be aware about. So everybody, I'm sure you have been dealing with understanding physical risks from climate change, as well as the transition risks that come up from humanity's response to mitigate against climate change. So I think there are many reasons why organizations like TIA and Nuveen, financial institutions, care about climate change. One is because climate change is an investment risk. There are many ways both physical risk and transition risk can impact the performance and the value of our investments, so that's why we care. But also importantly, there are many regulatory expectations for financial institutions to understand and disclose on climate change. So I'm sure some of you have already heard the Federal Reserve have put out expectations of scenario analysis to the 6 major banks. The insurance sector increasingly is going to be expected to do analysis on climate risk and disclose. And there are many other disclosure requirements that are shaping up here in the US. And there's many other kind of already existing regulatory frameworks in Europe, which I think some of our other panels can speak about.
Thank you. And then I'm just going to turn to Osho really quickly. If you can just give a high-level overview on how dClimate's approaching climate risk from a data perspective.
Yeah, so physical climate risk is an area of particular interest to us. When we consider climate and the impacts that it has on supply chains, we want to be able to quantify financially what that means. And there's various modeling techniques. You can get all into the AI, into the downscaling, into computer vision even, to understand at a very micro level or very granular high resolution level what potential losses from different climate events are. Particularly for physical climate risk assessment, what we like to look at is different climate change scenarios. Broadly speaking, it's the CMIP family of models, which basically highlight for a business what sort of losses they expect to face from different perils, everything from rainfall to heat waves, under different global warming scenarios. So maybe Earth's temperatures rise 1 degree, what does that mean for my supply chain? 2 degrees, what does that mean for my supply chain? And once you quantify these losses, these are models, these aren't perfect estimates, but they set guidelines for what a company or a local community can expect. And then that helps set the stage for the next set of things, which, going beyond disclosure, is building climate resiliency.
Yeah, thank you. And kind of going back to the point that Derek brought up around different types of disclosures that are coming up within climate risk, I'm going to turn to Sophia really quickly to just give everyone a little overview on different types of voluntary and mandatory regulatory disclosures that are coming up in the industry. I know there's a lot, so we can maybe keep it high level, but yeah, just give an overview to the audience.
Yeah, sure. I'm sure you are aware that a lot is happening in the market, right? So I'm not going to spend a lot of time, but I can just mention a couple of trends that are taking place right now that we're seeing from the Schneider perspective place, because we work with clients that are setting targets, disclosing risks. So we're seeing that regulation applies differently, right, in, say, the US and in Europe. In the US, for instance, the ISSB is not going to be applicable, right, because we're using GAAP, the general accounting principles. So ISSB is not going to be applicable here. They don't operate with that. But in Europe it's different, right? Because for many years, the regulators in Europe have been discussing with the ISSB on how to align, how to integrate the future regulation into what is known now as the CSRD, right? So we're seeing that this alignment, this integration, this mainstreaming of standards is becoming more and more common. We don't have any idea as to what the SEC is going to do with the new ISSB standards, but we know that with the recent endorsement from IOSCO, we will see some alignment from the SEC, hopefully, right? So that's one trend, the alignment. And the other one is what's going to happen with the voluntary standards, right? Because we have more than 200 standards on ESG. Climate risk, we have less. But what we're seeing is that they're going to become less and less relevant in the short term, in the medium term. Not those that are being part of the conversation of the setting targets or the setting frameworks in the US or globally, right? But some that haven't been part of the discussion will likely disappear.
Yeah, thank you. And Derek, just turning back to you really quickly, if you wanted to add more thoughts on some of the regulatory disclosures and kind of why it's important for businesses to start looking into them.
Yeah, I think it's a trend that I think we can't ignore. More and more investors are going to want to know about a company or an investment portfolio's climate risk elements, such as your carbon emissions or your exposure to high physical risk assets, etc. One point, though, and it might be helpful to kind of distinguish, there are a set of regulations that are more about disclosures, and there are also a set of regulations, predominantly in Europe, that are compelling companies to decarbonize and to come up with transition plans. So they are they're related but separate. And in the US, we haven't seen the second category of transition planning type regulations coming yet.
Thank you. And staying on that point of why it's important for businesses to look into disclosures, turning to you, Lauren, in your role, you're looking from a banking perspective. So can you talk a little bit about kind of the trends that you've seen in terms of the evolution in the climate risk space, and also where capital is flowing in terms of investments towards tools that are working towards mitigating climate risk measurements?
Yeah, sure, happy to. So again, thanks for having us. Hope it's a fun panel and a fun day. So just in terms of, I work in investment banking, and so a lot of what I'm seeing is kind of anecdotal, but just to talk about over the past couple of years, really what we originally saw back in the day is from a climate risk perspective, investors, so public equity investors, were asking larger companies about a whole slew of different risks, including climate risk. But in order to answer those questions and keep those shareholders, many companies were like, how do we measure this? What do we do? So from an evolutionary perspective, we saw a lot of companies that started out answering one kind of fundamental question of, what is this? How is this a risk? How can we measure it? And then how can we manage it? And over the course of the past 5 to 7, 10 years even, we've seen both a broadening of what that scope looks like, as well as a deepening of what that expertise is. And so you see more and more companies that are coming about looking at not only just emissions, but what does the entire ecosystem around emissions look like? What is insurance? How do you look at trading? What are all of the risks that a company are exposed to, from supply chain to operations? And so more and more companies are coming about to help larger companies and companies within their value chain answer those questions, figure out how to manage those risks, and then optimize, meaning they're either mitigating or able to capture a larger market based upon mitigating those risks. And so one thing that we're seeing a lot of, which is interesting, and from an investor perspective, is really important because they're looking at newer companies and smaller companies, not just filling an information gap of, okay, let's manage, but how do we, going back to Derek's point, how do we actually help companies reduce their footprints and manage their risks entirely when it comes to climate? And then on top of that, we're just seeing that added push into the value chain. And then once regulation comes in the US, it's going to be a little bit of rinse and repeat. So we're going to see a lot of companies coming through, adding in capabilities around what that looks like in terms of measurement, what it looks like in terms of assurances, and how that gets embedded in reporting back to the likes of the SEC. One note that I think is fascinating about the US, just as an aside, versus Europe is, and again, this goes a little bit with the history of flows and the history of where we're seeing climate risk being managed, is I had a conversation this morning that really touched upon this, but for a number of years, and you see a lot of firms that are kind of the older, larger firms that had come about that are really helping companies, educating them and teaching them to pass the test, instead of educating and teaching them for education's sake when it comes around climate and climate risk. And so there's been a little bit of a divergence in terms of where we're seeing the opportunity set and who's getting money. And it's flowing from the teaching to the test, to the teaching to actual solve real problems and have a true impact on a low carbon economy.
Yeah, thanks, Lauren. And I think one of the important points that you mentioned is learning about those gaps, right, and challenges before we get into solutions. So turning to you really quickly, Derek, can you walk us through some of the high level and important trends you're seeing in terms of the gaps and challenges that businesses face right now in climate risk? I know that's a loaded question.
Yeah. So I'm sure OSHA can speak all day about some of the challenges on the modeling front, but maybe staying with physical risks, we're inherently dealing with longer term risks that typically financial institutions, risk management is not accustomed to dealing in. And I might go as far as to say most investment professionals that are managing equity or fixed income portfolios, they're managing to 1 year, 3 or 5 year time horizons, if that. And based on their professionalism, they're not accustomed to taking super long-term views. But climate risk is something that requires a long-term view. So just getting that adoption of running the analysis, and I know there are uncertainties, but these are downside risks that all investment professionals should be accounting for. But having that analysis impact your investment decisions today, that's just kind of a structural challenge that we have to deal with. Related to that, maybe on the transition side, so we have a lot of scenarios to work with. NGFS, there's early transition, disorderly transition. We can assume a scenario of carbon prices that are in effect globally. We can work with scenarios all day long, but again, kind of risk management and investment professionals, they do kind of need a expected baseline to align their investments around. And to date, we have not seen any vendor being brave enough, I might say, to put forward a high conviction baseline view on where things are going. And maybe that is because it's just inherently very difficult to predict human behavior and how societies and policies are going to evolve. So those are maybe two things.
Yeah, thank you. And kind of just segueing off of that to you, Sophia, in terms of how businesses can really start adapting to some of the gaps and challenges that Derek mentioned.
Right. It's and following up on what Derek was saying, we've seen a trend also with our clients. We work with corporates, both private companies as well as public companies in the US especially. And we've seen that for the past, say, 5 years, companies were just asking us to develop a pre-TCFD report. Like they wanted to prepare for the TCFD report. That was it for many, many years. And starting 2 years ago, they started asking for, TCFD reports, like the full report, right? And over the past, I would say 6 months, companies are like, well, now I want to model my physical climate risks, right? And this is the point in which we are looking to partner with, say, dClimate or other vendors that offer these type of capabilities, because Schneider currently doesn't have these capabilities, right? But there are vendors out there that are gathering the data, climate data, for consultants like us to use, but also for companies or investors to use. And because we work across all sectors, we have to be very specific as to what we need from the platforms, right? From the systems we are analyzing or getting the data from. And this is a real challenge, right? Because companies are not able to generate this data. They are usually the sustainability managers of the company, so they are not familiar with the information. So we have to translate these into layman language sometimes. That is our role sometimes, to translate how a physical climate risk looks into the 2040 and how this is going to affect their operations, right? We talk with schools, like how school buses are going to be affected in 2040 by floods in Florida, right? So these type of conversations we have with our clients, right? And then we translate that into financial statements or financial impacts, right, for our clients, and all sorts of analyses, strategies. So in order to prepare for those floodings or floods, what you have to do. So this is our role. We develop the strategy. But we've seen this trend, right, changing over the years. And hopefully in the next years, we'll see companies only asking for climate risk physical assessments, for their sites.
Thank you. I'm just kind of segueing off of that to you, Osho. Why, obviously businesses are starting to adapt, but why is it important for them to start, working towards those climate risk mitigation strategies, things like insurance and the importance of data collection that we do a lot at dClimate. So from a management point of view and then data collection point of view.
Yeah, so to echo some of the comments that my fellow panelists made, it's that I really like that analogy about teaching for a test versus teaching to learn. And so when you have a corporate, when you have a business that is trying to just file a report, that only takes the data so far. There's a lot more you can do with it. And we have new financial assets coming up that can help mitigate those losses altogether, right? So that allows a business to do more proactive supply chain management and more proactive risk mitigation. So parametric insurance is a great example of this. If you know that your business is going to be severely affected by heat waves, then you can either plan to build a factory or whatever you engage in somewhere else, or you can start buying coverage against heat waves through financial instruments that trigger based on the actual amount of heat or temperature deviations in your area. I think one of the eye-opening examples for me as we started working on this was a case that we looked at where a bank had a mortgage portfolio. This is very common. Banks issue mortgages all the time, right? That mortgage portfolio, mortgage-backed securities are actively traded markets. There's all sorts of financial instruments around mortgages. There's all sorts of underwriting processes. But nowhere in that underwriting process was this bank or others taking into account necessarily the climate risk. And that just makes so much sense that was a light bulb moment for me and the team. Because if you're going to issue loans in, let's say, Southern Florida, right?
Scottsdale, Arizona.
Scottsdale, Arizona, even, yeah. Or my second neighborhood, San Juan, Puerto Rico. It makes a big difference what the value of that property will be, what the average annual loss will be over the coming 10, 20, 30 years. And if you can break that down into an annual basis, then you just have a much more comprehensive underwriting system, right? So it's not, when we talk about physical climate risk, it's not about necessarily just the company that builds a factory or the logistics operator. It can be much more abstract than that. And then that has a lot of impacts to downstream communities as well, right? If loans are exceptionally hard to get in an area because there's going to be lots of climate-related losses and banks are hesitant to write loans in that area, then that makes housing problematic for people who live there. And so you can see how this flows through down to the individual level.
Yeah, no, that's a great example, and I know that example really well. Thank you. So I think turning into kind of the tools and technologies that we're using to, start using those as a way to mitigate, different types of climate risk exposures that businesses are, going through. I'll turn back to you, Sophia, really quickly to just talk a little bit about kind of that industry perspective that you bring in terms of, why is new types of technology important to, consider as a part of your climate risk mitigation strategies?
Well, first of all, because we are dealing with exabytes. We are not longer dealing with spreadsheets. It's a lot of data that we have to process, and we need other tools to understand what's the impact, what is the hazard in certain time horizons for us to analyze better what's going to happen with X or Y sector, right? We look at technology in a very, it's not agnostic, sector agnostic. We have to look into specific particularities of the sectors, as I mentioned, because we work with apparel sector, industry, oil and gas. We work with all sectors. So there is there's one size fits all, right? We have to look at these particularities, and for us, technology comes into the picture. And partnerships, right? Like dClimate or others. At the end, we look for the best solution for our clients, not the best solution for us. I mean, we do our own analysis at Schneider, but that's separate from the analysis we do with our clients, right? And we have a list of questions that we sort of ask our partners. Do you offer, for instance, value at risk? Can you put data into the system so we can customize the result, especially the financial results, things like that.
Yeah, thank you. And then going back to you, Sho, in terms of how, and maybe from a dClimate perspective, firstly, why is it important for businesses to start considering new tools and technologies such as blockchain and AI? That's something that we use across different solutions in dClimate. And then secondly, from our perspective within the physical climate risk space, how is technology really taking those solutions to the next level?
Yeah, so in terms of AI, for example, in this problem, I mentioned earlier that there's a lot of work that we do around computer vision and downscaling. It's fun to do, but we're also not just like doing science experiments. So the reason we have to do it is because a lot of times these climate scenarios that we work with are built for a higher or coarser granularity. So they might talk about how all of Manhattan, for example, might be impacted by climate events in the next 10, 20 years. But that's not necessarily helpful for a single property manager that has buildings maybe only in southern Manhattan, right? So being able to take all this data and being able to downscale it to be location specific, when you get that granularity, you can bring scale and you can bring transparency because you can do this on a neighborhood by neighborhood level. Now, in terms of the blockchain use case, when we took on the physical climate risk assessment software product, we are not interested in making it a blockchain product to make it a blockchain product. We do, however, have all of our data on chain. And that's relevant because earlier today I mentioned that dClimate is indexing and organizing global climate data. And the part I left out was that we're actually doing this all on chain. And why does that matter? Well, when it's on chain, you now have an immutable record of what was going on. So you can show an enterprise client or an industrial that has a large financial stake in this process being correct, exactly what data was used for your analysis and how that data changed over time. You can go back and see the revisions that were made and see what worked and what didn't. Because this is a brand new space where different models are coming out, different methodologies are being tested. And finally, on the actual user end, the user interface, it's been interesting because Sophia's right. There's no one size fits all. It would make our lives a lot easier if there was a one size fits all. But different clients in different sectors need different ways of looking at the same risk, and that's something that's the core of what dClimate does with its climate data and its analytics products. The same wind speed data that a wind farm uses, if you graph it differently, can be used by an agricultural company that faces loss from wind, right? That was essentially the idea where all these apps essentially came from. And so for certain clients, they want that financial loss number and they want it to be as accurate within some bounds as possible. Others want a generalized risk score. So how do we start turning this into indices so that they can get a quick glance at how they're impacted? And what's cool about that is once you start generalizing, and once you have these risk scores and you have these indices, this opens up a whole new financial world of making these indices tradable, right? Once you can bring that kind of liquidity in, you again have started developing a new asset class where capital can be efficiently deployed to provide the right sustainable outcomes for the different businesses and individuals involved.
Yeah, thanks for that insight. And then quickly to you, Lauren, in terms of the capital flow that you're seeing going into different types of tools and tech, whether that's specific to physical climate risk or just ESG solutions in general. Can you just talk a little bit about what that's looked like over the last 5 to 6 years, and where do you see that going in the future?
Yeah, if only I had a crystal ball. It would be amazing. So I think where it's been, I think generally has been solving more simplistic issues, and then as more data gets collected, it opens up more questions not only from the investors but clients, consumers, what have you. I think the concept of radical transparency and consumers getting just as much information, sometimes even faster than the C-suite, has been driving a lot of decision-making processes when it comes around all things environmental and social within this world. I think a couple of different places where there is an evolution still happening, and again, a lot of this is nascent, but basically at the end of the day, many of these are risks that were external that are being internalized by companies that they now have to mitigate and can potentially make opportunities after, and investors like that, right? So they like to know that you're not going to lose money, and they like to know that you might be able to gain money, right? So at the end of the day, that's really what they're looking for. So part of that is just expanding the system and looking at, first it was carbon, and now what else is in that ecosystem, and what other things are being questioned by investors, by consumers, by customers that will be a driving force where they're going to be looking at data in different ways. 5 years ago, we weren't looking at physical risk in the same way that we're looking at it now. And then really bringing that in one place that I still see a big gap, and we talked about this a little bit, is the intersection between the major decision makers, i.e. board of directors, C-suite, and who's making the decisions of making those reports or looking at the TCFD and seeing how that measurement and that disclosure can actually impact the business. And so having any of that data concentration within a company as well as outside, I think is really interesting and fascinating. And then also there's the intersectionality of humans and climate, and looking at those considerations from a macro as well as a micro perspective. How are you going to move your people around based on, if you have a plant in Arizona and there's no water and you need a lot of water to make whatever it is that you're going to make, how can the data and how can the information and these tech platforms help me make better business decisions so that I don't end up with a stranded asset and I end up creating a massive opportunity that might very well be cheaper by building something somewhere else where I can bring my people there for a better quality of life, which means reduced turnover costs. And then it all comes back to that financial ecosystem as well. Like, how is this technology helping to mitigate risks, and how is it opening up opportunities so that I can see around corners better?
Yeah, thank you. And then lastly, just turning over to you, Derek, talk a little bit about what Lauren said in terms of some of the solutions and how they can be sustainable enough for businesses to make decisions off of. So as a financial institution, as an asset management company that you're representing, how do you, or kind of what are the priorities that as a financial institution do you have to take into account when working towards your climate risk strategies? And then I guess like a sub question within that is, how are you considering, there's so many different vendors within physical climate risk, transition risk and whatnot. How are you prioritizing those?
Yep. And I might touch on some of the comments that Osho made and Lauren made. I really like the analogy, you might be doing this just to pass a test versus actually learning. I kind of overlay that to like, what are you doing to check the box in terms of your disclosures versus what are you doing to actually manage the risk? So there is a little bit of a bifurcation even within our company. There are tools and vendors that are shaping up to make it easy for us to get a bird's eye view of the entire enterprise across multiple asset classes, so that we can have something standardized across the board, but also makes it easy for us to articulate the risk and disclose them. But what we found is that at each asset class, the investment teams are gravitating towards more specialist approaches that are really attacking the question appropriately. So as an example, Nuveen, we are the largest manager of farmland in the world. And there, we're working with a vendor that really has deep expertise in how weather variables might impact crop yields. So that's pretty obvious. So I'm sure there are many vendors who are finding their niches, because it's not just about understanding how climate change and different hazards like hurricanes or floods would manifest, but the important question is, how would those weather events, severe weather events, actually impact asset values and your operations? So I think that part of the equation is a little bit less scalable, and I think there's a lot of runway, a lot of opportunities for many different vendors and specialists to really deepen their knowledge and their sophistication on that front. I don't know if I answered the question.
No,
but
that was really
okay,
helpful.
okay.
Yeah. Well, thank you. I think I just got the... are we out of time? Okay, cool. Sorry. I know there's a lot more we could talk about, but thank you so much for taking the time, to all the panelists. And yeah, thanks for joining.
Thank you.